All right, I guess let's get started. Good morning, everybody. My name is Spencer Casimir, and on behalf of the Harvard Club of Victoria and Harvard Alumni Entrepreneurs of Australia, I am so pleased to welcome you to this Zoom get-together, this campfire with our good friends Scott Kominers and Matt Vitale, as well as my good friend David Nile. This may not be the accent you were expecting coming from Australia, but I guarantee I did have my Vegemite on toast this morning, as the others can attest to. This meeting is going to cover some fascinating topics, and it is just such a pleasure. So today, Professor Scott Kominers and Matt Vitale from Birchall, Australia's leading equity crowdfunding platform, will be covering the opportunities and threats of the changing marketplace landscape and lessons learned from 2020. This is an area I'm sure that a lot of us are absolutely fascinated in, whether you are here in the country, just one over in New Zealand, or anywhere around the world.
Okay, thanks, Spencer, and welcome everybody. A particular welcome to Scott and Matt, and thanks very much for your contribution to the club and for presenting at today's event. So I think we might just get straight into it. Scott, you're the expert in market design, marketplaces, and have got a really strong theoretical and understanding of the area. And this year has been a year unlike many others, and I don't want to get into the detail of it, but it has been, true disruption in so many levels. Just wondering if you could just explain the concept of marketplaces and how this year might have challenged past practice and what changes might have taken place in marketplaces due to the changes this year.
Totally. Awesome. Well, so first of all, David, let me thank you and thank Spencer for hosting. It's a real thrill to be back in Melbourne, albeit in this case virtually. And in particular, I also owe you thanks because you're the one who first, sort of said, you've got to meet this guy, Matt. So, you knew my excitement about marketplaces, and you knew one of the coolest marketplaces going on, in Australia and in the world. And you said, you've got to meet this guy. So the co-panelist, who we'll start chatting with in a second, is your introduction. So thank you so much for that. What is a marketplace? So you just got to sort of step back one step and ask, the preliminary question, which is what's a market? And markets are things we actually interact with all the time. Markets are everywhere that, people interact and seek to transact subject to incentives. And so there's sort of the classical things you think about, a financial market, where people are seeking to buy or sell securities or other sort of financial instruments or acquire and take on or grant debt or something of the sort. But there's also sort of markets that are sort of everyday life things that we don't always necessarily think about as markets, but are dating. You've heard about this marriage market. Well, the marriage market is a real market. There's a sense in which you're going and interacting with other people looking for a transaction. I don't mean to be too transactional about it, but there's a transaction. You're looking to meet and make connections with people. You certainly respond to incentives. You might dress differently. You might sort of represent yourself differently. Put your best foot forward. Represent your best characteristics. A marketplace is about trying to organize and bring structure to a market. And marketplaces operate really on two dimensions. In my book, there's rules, which determines who transacts with whom, which types of transactions are permissible, sort of the way in which sort of transactions can occur, and infrastructure, which supports the doing of transactions. So, if you think about a dating platform, we'll come to some finance and crowdfunding in a moment. But if you think about a dating platform, there are lots of rules about who's allowed to communicate with whom, sort of which messages or which messaging is permitted, how you search. And then there's infrastructure, right? They often provide communications tools. They provide sort of a safe, sort of circumscribed way to communicate with each other. But of course, pre-pandemic, the typical dating platform was mostly investing in trying to enable you to broker connections for real in-person meetings. And suddenly real in-person meetings are a lot more dangerous than they used to be. They require a lot more effort, a lot more, sort of infrastructure, you might say. And so there's been there's an instantaneous pivot, right? Which is that a lot of dating sites basically overnight had to figure out how they were going to broker virtual meetings. And like, how do you enable like the creation of connection and trust and engagement in a mode that is virtual? And then, but some funny things happen. And one of them is the thing we're seeing right here, which is the second dating is a predominantly virtual experience, or at least the early stages are, it suddenly goes from being a very localized market to being a potentially like much broader one. Maybe a global market, but at least, sort of outside the range of places where you normally would have gone to meet people. If, you're just looking to make connections with people everywhere, if all of your connections are over Zoom, or some internal, sort of meeting platform, all of your connections can be drawn from a bigger set. And that's like a really simple example of how things have changed, right? What's happened in this pandemic on the consumer side is that all of consumer habits have been disrupted. And so if you think about a marketplace as trying to enable different types of transactions, there are many new transactions to do that no one's ever tried before. And so there didn't exist a framework in which to do them. There wasn't a marketplace for you to do like virtual video dating because that wasn't a product that was in a lot of demand. And meanwhile, there were marketplaces for things like grocery delivery, right? In the United States, we had Instacart and Amazon Fresh, but overnight, those marketplaces went from sort of demand constrained to supply constrained. Previously, Instacart's problem was they couldn't convince enough people they wanted delivery groceries. In 24 hours, their problem was that they didn't have enough grocery stores and drivers to serve all the groceries to the people who wanted to buy them. And so the platforms were sort of caught very flat-footed, right? They weren't set up. They weren't optimized. They didn't have dashboards or metrics to understand what was going on their supply side because all of their investment had been on the demand side. And suddenly, they had more demand they could deal with. And so, as somebody who studies marketplaces, this is just like an incredibly sort of like fascinating time, right? You're seeing lots of new business opportunities that are created as people are trying to find new ways to connect and to do things that previously they had like sort of established daily patterns for. And one of them, of course, is, sort of at some meta level, I suppose, is if you're an individual and you're looking to invest, first of all, you maybe now have a little bit more time to do it. But second of all, you might not have the same vehicles to gain information you had before. And meanwhile, if you're a company, I hear there's a little bit of, sort of disruption and difference, which might make, an equity crowdfunding model a little bit more valuable. Matt, so I want to have you quickly tell people what it is that you do, and then I want to get straight into, the action question, if you will, and take us back to like mid-March. But just quickly, like, what is Virtual and how does it work?
Yeah, thanks, Scott. And look, delighted to be here. And thanks, David and Spencer, for arranging this. Virtual is an equity crowdfunding platform, and an equity crowdfunding platform basically enables companies to raise money online by issuing shares. That's it, pretty simply. Securities offerings are, as you would imagine, a very highly regulated space. So there was some legislative change that was needed in Australia to allow us to do what we do. And there are two real game changers of the legislation that we take full advantage of. And the first is that proprietary limited companies, so small private companies in Australia, can now have a potentially unlimited number of shareholders. And we can advertise these offers online. So they're probably the two major things. And we help companies basically raise capital from their most passionate customers and fans.
So first of all, that's just totally awesome, right? Like, that's like a really fun thing to be doing. Imagine it's like super rewarding on a day-to-day basis. You're helping like companies work with their greatest fans to like hit the next level.
Absolutely.
So let me take, we had this conversation, sort of, earlier this month, where you talked about what it was like sort of standing on the precipice in March. Like you said, you had a campaign running. Like what was going on, and what were you thinking at that moment? What was going on with the platform? Talk us through it.
Yeah, look, I think it's probably useful to back up a little bit and talk
Good.
about the problem that we solve, because I
Great.
think, echoing your comments earlier about this accelerated disruption, if you like, it was a similar thing for us. Like raising capital for an early stage business in Australia has just been so difficult for so long. And it's a closed network usually, and it involves coffees and catch-ups and a lot of in-person stuff. But because you can't advertise or couldn't advertise on social media, you're limited to people that you can touch, often in the physical sphere and your immediate networks. So it took a while for the legislation to come in, and the regime was picking up and gathering pace, and last year was a great year, and we look at the UK regime as one of the more mature industries that we would like to emulate in Australia, and certainly we're experiencing a very good growth trajectory. And then COVID happened, and around March, things started really escalating in Australia, and I was watching with keen interest what was happening overseas, but it was really around early March that things started to escalate for us. And we had one campaign that was live at the time, and if I look back, it was somewhat fortuitous, because this campaign had already raised about $1 million. It had, didn't make a decision to open during COVID. It was already open, but we got very nervous to see what the investor response would be like in such economic uncertainty. And I remember the day specifically. The ASX had dropped a significant margin, and we were wondering whether or not the campaign would just peter out, or if it would actually continue. And the company was the Seabin Project. So it's a rubbish bin that sits in the ocean and collects marine plastic and waste marine plastic. And they were able to raise 600,000 in the last 2 weeks of their campaign, raising 1.8 million all up. So it was really encouraging for us and for the rest of the companies that are in our pipeline that it's still possible to get these deals done. But certainly some of the larger investors that were looking at investing had, disappeared because, as you would imagine, that have exposure to, listed space and other things that were going on in the market. But 1.8 million was still a, tremendous result. And then that gave us confidence to, kind of keep pushing and telling companies that, yes, crowdfunding is still open.
So, but now tell us, like, what do you do as a founder in that situation, right? Like, you have the confidence, you can tell companies, yeah, you can still do this, but what did you actually do?
Yeah, look, I think there was a couple of things. We first reached out to a lot of the companies that we'd funded previously, and really, not to offer them any services or tell them that they should be raising capital, but just to check on how they were going. That's a really big part of what we do. We're very company focused. So we feel that we're providing a valuable service to companies to, access an audience so they can raise the capital they need to execute their plans. And everyone's encountering difficulty, and we just wanted to reach out and just be a support, hopefully for the companies that we'd funded. But then the companies that were looking to open offers, some of them, they just put their plans on hold. So, there was a few in the hospitality industry. There was one that was, looking at opening a bar, a tap room, which is not who knows when bars are going to be open in Melbourne again. So that wasn't a great, candidate for a crowdfunding offer. It was going to be a tough message to sell, but increasingly we were getting other businesses in our, in our pipeline that were trying to raise capital through other means, and it was becoming impossible for them. So there was more companies that were, looking at raising capital and finding a way to get a deal done in this environment. And the advantage that we've got is that it is entirely an online process. So people were, at home figuring out what does, the world look like on the other side of this crisis, and spending a lot more time on social media. So, we had I suppose, a hypothesis that that things could still get done, but it was, a slowly, ginger process, and certainly brave for the companies that that subsequently opened offers, made a decision to open an offer in these conditions.
Totally fascinating. So first of all, I just want to like add a footnote. This part about the ongoing relationship with the companies. This is something we're seeing in marketplace businesses more and more, right? Like the earliest wave of internet marketplaces were your Craigslist or your Care.com. It's basically just a listing service where people can post like, here's a thing I have, or here's a thing I'm looking for. And they were very hands off. They were just sort of there to provide the listing. And it turns out those businesses, first of all, they don't add that much value themselves, right? They're just like, sort of a bigger, like expanded listing, sort of platform. And they're often very hard to search and navigate. It's hard to find what you want to. But they also, sort of talking about infrastructure, right? They're not doing very much to aid the transaction at all, which, sort of at the level of the platform means they can't charge very much. They're not doing very much to, they're an all volume business, right? Every single one of them is just trying to maximize the number of transactions that happens. But the other thing is that they're very commonly disintermediated, right? If like you would rather avoid, being a part of this listing agent, whereas with a platform like Virtual, right, you've got this ongoing relationship with every company that you help raise, and you're providing this new form of capital to access that you hope they're going to access at multiple different stages of their process, which I just think it's cool. It's like just a thing I like about your company, and it's a great like indicator for I know some of the people here are thinking about broader marketplace design and like maybe even launching and running their own marketplaces. This is a big part of how marketplaces create value today. But the other thing I like that's really interesting and is you started to say that the companies that wanted to run offerings were changing. What are some examples? Like what are the like pre and post COVID offerings look like?
Yeah, look, I think the very early days of the crowdfunding regime, it was just purely the early adopters. So super early stage companies that it's hard. It's always hard to raise capital as an early stage business, particularly so in Australia.
Sure.
We don't have, the kind of deep pools of capital, of venture capital that you guys have in the States. And, I think we need to create more of an investment culture in Australia that will, serve our national interest and our economy long term. And, hopefully equity crowdfunding has a role to play in that, in getting investment out, for the every man and woman. But we're starting to see later stage businesses that don't fit the profile necessarily of a startup, looking to raise capital. A couple that are, they had transactions that that for a variety of reasons couldn't be completed in this environment. There's been changes to foreign investment laws in Australia, which mean that foreign acquisition of certain companies can be a lot trickier to execute. But also just the fact that, larger investors, either they weren't investing or they were seeking more value, and, kind of driving harder bargains, and more businesses were, awakening to this new way of raising money, which we're obviously delighted about.
Super cool. So like, so it sounds like it's really what we would call in economics an extensive margin story, right? So you guys are sort of growing the pool of potential investors, and potentially growing the pool of potential investors in a way that's like especially well aligned with the companies. And so when companies discover that like, whoever they thought was going to invest in them is unable to or unwilling at this moment because they're facing some other like capital risk, now suddenly you have this like big like liquid fringe of smaller investors. And this is like when the companies start to experiment. This is actually very much like what we see in the consumer markets, right? We've got these, contexts where, nobody's ever tried virtual, or very few people have tried virtual personal training. But now like, all the gyms are serving virtual personal training. And because you don't have your previous option, you have something new to go and try. Again, like sort of this has been like a big force that's sort of driven marketplace development here. Super cool. So then, maybe like another. Go ahead.
The other point that I'd make on this is that we provide a far better service than what was available to a lot of these companies previously. So historically, early stage capital And I don't want to knock all of the, corporate advisors that are out there helping early stage businesses, but, the limited options for businesses that are starting out to raise capital. So often they have to pay high upfront fees to prepare an information memorandum. And then, the model is typically that an advisor will, cultivate a list of investors and then charge a company for access to that list, and help them through that process. But it is an expert-driven process, and it takes time. Corporate advisors, they're professionals, and they need to get paid in the same way that lawyers and accountants do. But I suppose our process really enables companies to, dip their toe in the water and see if there is demand for their offer before going to the effort of, preparing all of the documentation and, spending lots of money on advisor fees and things like that. So they can kind of form a view of whether or not this is a worthwhile exercise before actually getting into it. And that makes them happier. That is a better service for them. And I think that, the tailwind for us is that, COVID has created a greater need for companies to raise capital, and then, I suppose, introduced how this is actually a better service if you're an early stage business looking for capital.
So this is another really common property of marketplace businesses, as a side note, right? That they actually grow the pie for everybody, right? They're like a lot of marketplaces, again, in this modern era of marketplaces, a lot of them exactly like that are, providing a service that is strictly better for all of the market participants. So you can make money and make everybody better off at the same time. I think about this like now with, it's starting, a lot of the, the delivery services, I think got it sort of flat backwards, right? They worked really hard to, because they were demand constrained rather than supply constrained, they worked really hard to convince consumers to buy the thing, and then, didn't really invest in their suppliers. But now we're in this moment where, all the consumers want to buy delivery food. There's no supporting infrastructure set up to help the suppliers that are like, the local liquor store or the local restaurant, become like an all delivery business, right? We could have been in a moment where the marketplace could have set all of these firms up to sort of just seamlessly pivot to be 100% delivery. So I think I think in that case, like there was a lot of like opportunity lost. But so when you're doing something that's sort of win-win-win, when you're like providing sort of a type of transaction that's better for all the parties, often like bringing in new participants to transact with old participants and building all of the pipeline in between, you've got to then ask, like, why hasn't anybody done this before? Seems like a win-win for everyone. Like, why? Like, how did you guys do it first?
Yeah, I mean, look, the simple answer to that is it wasn't legal before. Companies couldn't advertise their offers online, and I think that's the real game changer. And when we look, overseas in other regions, and how equity crowdfunding regimes are regulated, that's probably a key element for us, is the ability to advertise in an unrestricted way, because it is really about having a company focus. We feel like two-sided marketplace. Do you focus on the investors or do you focus on the companies? Really you have to focus a little bit on both, but we are really a company-focused platform. So we never wanted to be, a deal-focused platform where, the most valuable piece of real estate is the landing page where you see all the deals that are live. The architecture or the structure of our platform is every company gets a company profile. They've got a URL that they'll use for the same URL for the lifetime of using the platform. And all activity is driven to that page, their profile. So we're helping companies build an audience that is relevant to them rather than building a virtual audience. The virtual audience is the accumulation of all of the offers that we've completed in the past. And as we do more offers, then, we're starting to see people investing in multiple campaigns. And that's a, great and interesting dynamic that, we'll work on and evolve over time. But what has worked for us is just being supremely focused on the company and finding, the most relevant audience for each company, and showing their opportunity to that audience efficiently and cost effectively, and treating each one of them as a discrete project. And I think that's probably the game changer from, our platform, whereas previously, a lot of the platforms would focus on just building the universe of investors, or the database of investors, and then charging people for access to that. But there's so much more that's involved in executing a successful campaign. So every company gets a campaign manager, and we add all of this additional value that that perhaps hasn't been considered. It's more than, we've shown that it is more than just having a big list, and showing the opportunity to the list, and hoping that that some people invest.
But so I love that. Strategically though, it sounds like almost an edgy choice, right? That like you're not in it to own like the audience, like there's like, how'd you get there, and why? Like what led you to that idea?
Look, I think purely the fact that we almost started from scratch. We did. So Alan, my co-founder, co-founded Possible, which is a reward crowdfunding platform, which is a very different model. But starting an equity crowdfunding platform, we didn't have, I suppose, this list of investors that had invested in previous campaigns. So we had to work really hard for the companies that that came to us to figure out actually how do we build an audience for this company, and just build it up from there. And I think starting from scratch and going back to first principles was really a great thing for us, and has put us in good stead to grow the platform sustainably. But the other thing I'd probably add to that is that before the regime actually started, the advertising. So before we got our license, the legislation came in, and the advertising restrictions were relaxed. So we set up what we call an expression of interest process. And this is, as I mentioned, a pre-offer marketing phase where we can assess how much demand is out there for the offer. And it's that has really kind of underpinned our process, because it allows us to get really good data insights that get better and better the more campaigns that we complete. So we can say to a company, towards the end of the EOI, look, this is, how much demand we think is out there for your offer. And, that's so valuable for a variety of reasons. An equity crowdfunding campaign needs momentum and early traction, so you can leverage that support to convince other people to invest. And, that's our instrument panel, if you like. And kind of circling back to our concerns with COVID, that was probably one of our key concerns was, are our conversion rates going to drop? Like, the things that we know about the EOI, so we can provide guidance to companies, will they still hold true? Because if they fell apart, then, it's like flying a plane without any instruments. It's pretty tricky. So, but thankfully they've become, even more robust. And, we've uncovered perhaps, some of these rules of thumb that are continuing to prove themselves in our business, which, is fascinating, but also very useful.
Love it. We'll come back to those rules of thumb. Oh, go ahead, David, go for it.
Look, I was just going to comment that Matt, with Birchall, there's a very local regulatory framework that you're restricted to, which to some extent restricts any sort of global, or makes it more complex to go global. At the same time, we're seeing, the investors in the stock markets around the world are putting a lot of money, and a lot of value has been created in those large global technology platforms, Alibaba and Amazon and so on. So, Scott, I just wondered if you could talk about the framework, because some of those large global companies have got probably elements of marketplaces in their models. Of course. How do you make that, in choosing to invest or establish a marketplace like Birchall versus, going global? What are some of the frameworks or issues that you think are important to think about?
Totally. So actually, this will feed very nicely to where I was going to start directing us, in a second. So I want to work our way to understanding opportunities, right? I want to understand like sort of like what are the opportunities that are out there. The the question of like sort of global versus local platforms is very much about the types of transactions you're imagining, right? Like, you know, and also to some extent, what are called returns to scale. So, um, you know, some types of business have tremendous returns to scale. So, if you're Amazon, you have to run a logistics operation, right? If you're like Amazon is principally a logistics business, really. Like, they have a web store. Like we interact with them as, as a platform for buying and selling things. But realistically, like Amazon's like real expertise and sort of investment, at least on the consumer products business, and this isn't like AWS, web services, other things like that. Like, the consumer products business is about logistics. And if you have to be able to manage a logistics, sort of chain all the way across a country, that has sort of returns to scale of like, once you set up that chain, you can deliver a lot of things. And it's very costly to set it up in the first place. You can't you can't set it up when you're just delivering a few books. You're going to use like, the local postal service or FedEx or something like that, some existing logistics partner. But when you get very, very large and control a large part of the market, then you have, then the returns to owning your own logistics process are very high. And so, you see sort of global marketplaces when they have like some and global platforms more broadly, when they have some component of increasing returns to scale, or when they have very strong what we call global network effect. So a network effect is something that makes the platform more valuable, to one participant if some other participant is present, right? So a platform like Virtual is more valuable to to companies if they have a lot of investors, and more valuable to investors if they have a lot of companies. Similarly, an Amazon is, sort of, the Amazon marketplace is more valuable to sellers if they have a lot of customers, and customers if they have a lot of sellers. Sorry, I had my demand side on one side and supply side on the other, and then I switched them. But it's two hands. The sometimes these network effects are almost exclusively local, like with the dating platforms I was talking about earlier, especially like pre-COVID when people were dating and like really focusing on going on in-person dates. It's not very useful if a dating platform, can introduce you to somebody, sort of half a world away, usually. And so, you might see different dating platforms taking hold or having like different sort of sort of like, levels of engagement across different cities. Similarly, at least in the United States, like, most major cities that have a, one of these like local bike share operations, Hubway or Blue Bikes or whatever, they have different ones. There are different companies running the local bike system because that's really only a local network effect, right? Having a bunch of like bikes distributed across your city is super useful, but somebody who's a member of the Boston Bike Program doesn't get a lot of benefit out of also simultaneously being a member of the San Francisco one, which means that a different company could be the leading San Francisco bike share. There's this company but sometimes local network effects turn global, and this we've seen a lot in the current pandemic. So there's this company I advise and also wrote a case on called Lunch Club, which is fascinating because they're an algorithmic networking platform. They're about sort of like connecting people for like, networking and sort of professional meetings. And they were all about one-on-one in-person meetings. And then suddenly in the pandemic, they switched to Zoom. And then they, started saying, well, why don't we match you to not just people in your city, but like you can match with people anywhere. And it turns out the value of a networking tool that takes you out to people who are in your field and of interest to you, but very far from the network you run into regularly, can be way more valuable than one that just sort of expands your network in your local site. And so suddenly this like very localized platform became global. Now, of course, there are regulatory barriers, like David, you were mentioning with crowdfunding. Like every country has its own crowdfunding regime, and so there's this there's some complexity to becoming a global platform. But like once you gain those global network effects, assuming there are no sort of like functional barriers, then you can become a global business. So I was just like sort of riffing on some different opportunities for for marketplaces and scale. Matt, I wonder if you could speak. I mean, you have like one of the best views I know into like what is currently like, what are the opportunities people are excited about? Can you like, just tell us, I've got a bunch of entrepreneurs on the call. I'm sure they'd be curious.
Yeah, I mean, it's I suppose it's hard for us to pick any one, sector. Like the ASX, at the moment is very thematic. Everyone seems to like these large, fintech business, Afterpay, and a lot of these technology companies. But what we do is actually quite different because, as you said, like it's building communities, often kind of locally focused. We work with businesses that have a strong consumer proposition. So, to say that there's one particular group of your, industry that will do particularly well, it's pretty hard for us to, to make that statement or make that observation. Certainly at this point in the, early, despite the strong growth, but still very early stages of the industry. But it's having a strong consumer proposition. So, what we say to companies is, your audience, it's who cares about your existence? Who will stand to benefit by your success or you being in the world? That's, the questions that, will define the audience that will market your opportunity to. And there's like, obviously we've done a few craft breweries and, that's the archetype of the crowd-funded business. You form the view that someone likes the beer, they might like the company too, and, they'll be a potential investor. But we've proven over the last couple of years that it's so much more than that. And we've done a few offers for B2B businesses. And one that I often talk about is a business called Advisor Ratings, which, it's essentially a data business for the wealth management and financial planning industry in Australia. So it's not very sexy business when you compare it to, craft beer with a very strong brand. But financial planning in Australia, particularly the last few years, they've gone through a bit of turmoil, and there are a lot of advisors that are leaving the industry because of the regulatory challenges. But this business, many advisors, form the view that they are part of the solution, that they are part of the future of the industry, and they'll help lift it up. 65% of the people that invested in that campaign were financial planners, and they raised over $1 million last year. So it's a great example of a business that you wouldn't automatically think is, a good candidate for crowdfunding, but it does demonstrate that it's all about finding a passionate audience who stands to benefit from your success.
So I love that. And you've reminded me of like the other thing I should have said when David asked this question about global, because the other thing that's really succeeding right now is ultra local, right? Those passionate fan bases, right? If you look around, I'm sure everybody on this call knows some nearby restaurant that is doing really well in the middle of the pandemic, right? Like, we are living in sort of in a retail and like sort of like small business depression. Like there's like tremendous strain on all of these businesses. Speaking of which, everyone here, like, next time you order food, like tip your delivery driver and tip the restaurant well. Like, these businesses and like these sort of like gig economy workers, like they really need it. And this is like a time when we should be taking care of them to the best of our ability. But side note, so like, but there's also like, there are a couple of restaurants around here that are doing really, really well because they have these passionate fans who suddenly now, like every time, like going out for food or like there's sort of going out or acquiring takeout is suddenly like an even more of a luxury than it was before. And so they're choosing these couple of businesses that they care that much about. And you're seeing that over and over again. Like people are like aware of things in their local community because they're not getting on planes, right? And they're like, investing in things that are sort of like local and close. And so in that sense, if you're a business of any style where like you have sort of like a real like serious appeal and a fandom, and especially perhaps a local fandom, like there's a tremendous amount of value you can help create and capture right now.
Absolutely. And we've thought about this quite a bit because, obviously back March, April, and particularly now, like even in Melbourne, we're still in, what we're calling stage 4 lockdown, which means, you can only leave your house for exercise and groceries and things like that. But a lot of these hospitality businesses are doing it tough, and they will be doing it tough for some time. But look, we certainly had chats with a few of them that looked at equity crowdfunding, but it's, equity is not really the right security or arrangement for something like this. And, you know, when we kind of think back on the investor side, you know, these businesses, you know, they don't really want to go through, you know, valuing, you know, arriving at a pre-money valuation for their, or an enterprise value for their business. They're not really growth businesses that investors are kind of going to invest some money and, you know, I expect that they're going to, you know, have this large accelerative growth and therefore appreciate in value. But there are probably a lot of people that are passionate supporters of the business that would loan them money and perhaps not charge interest, not expect interest, or maybe take interest in kind. And this is one of the, I suppose, the additional or additions to the regime in Australia that we'd like, is to be able to offer debt securities in the same way that we do equity securities. So, you know, because it doesn't really make sense for, you know, your favorite local restaurant or your favorite, you know, barber, hairdresser to be preparing a detailed, you know, offer document. It's probably more like a, you know, a simple term sheet, and rather than paying interest on the note, you know, you can take a haircut on your investment, you know, in actually, like, it's a good haircut that you'll like, you know. It's
Tell me you've used that one before.
yeah, we've been kicking it around a bit in the office. You like that? So, yeah.
I need a haircut on my investment. I've still got full-on quarantine hair here.
Yeah, me too.
So I just wanted to let everyone know that there's an opportunity to ask questions through the chat room, and we've got a few minutes left. But Matt, just one thing around that, you know, the regulatory change, and Scott as well, the issue of you know, strong regulation supporting marketplaces, but we're seeing fairly interventionist governments on, you know, through the pandemic. They're trying to work out how to accelerate growth afterwards. What's the sort of, I suppose, regulatory frameworks that you think could really accelerate opportunities as we get out of the core of the pandemic? And is there anything there, that one or two suggestions that you'd think would really accelerate or free up you know, the potential of marketplaces?
Yeah, sure. I mean, one of them we've sort of already hinted at is more things that enable global collaboration, right? Suddenly everyone's gotten really used to, or like sort of everybody who works in knowledge work in some fashion, or in many other types of employment as well, has suddenly gotten really used to working remotely. And once the costs of interacting with the person whose office is next door to you are the same as the cost of interacting with somebody across the world, right? The opportunities for global productivity are much higher, if only, like, you know, the regulatory framework was in place, you know, with all the appropriate protections and such. The other one that comes to mind is there are all sorts of new emergent technologies that, you know, have sort of seen tremendously accelerated growth paths due to the pandemic. So like telehealth is my favorite example of this, right? You know, at least in the United States, like, you know, virtual medical visits were something that we had the technology for, but nobody had really optimized it because the regulation was maybe 10 years away. And suddenly, you know, the regulation has said, like, look, you know, we understand this has to happen. And a lot of doctors' offices switched many of their appointment types to telehealth, which means they can see more patients. They can see patients over distance. There's less travel, so like, you know, fewer cars on the road. Like, you know, this is better in many, many different ways. And we just saw this acceleration, and the technology caught up really quickly, right? Like, there's an incentive to invest in the technology immediately. So keeping that sort of stuff in place, I think, is also very important, right? We shouldn't lose any of the technological sort of opportunities we've gained from the pandemic by seeing regulations sort of clamp back down as soon as, you know, you don't have to use these things out of necessity. What do you think, Matt?
Yeah, look, I think certainly with equity crowdfunding and investment, it's just reducing the friction points. And in Australia, there's several, like, you know, people are investing. I mean, you invest because you want a return. I mean, that's the starting point, right? You're hopeful that the investment will appreciate, and you'll, you know, be able to realize that return. And this is something that we're working on, offering a secondary market facility without, you know, in an economic way that doesn't overly burden companies, but we need some adjustment to that. At the moment, it's fairly restrictive. I think, you know, as I've mentioned, the, you know, getting debt securities will like an additional suite of products for these companies, because it's not one size fits all for the circumstances that they're in. In terms of global interaction, though, it's one of these things that yes, like, you know, I mean, you even told me that you've seen a few opportunities on the platform that you'd like to
Oh yeah.
invest in, but you know, then, you know, the question is, geez, you know, it's so hard. Like, what do I have to think about the, you know, overseas taxation and the securities regulation? And, you know, the last few years, there's been a lot of talk about, you know, blockchains, you know, STOs, ICOs, and all of these things. And I suppose my view on this is that, you know, it's a great technology, but it kind of puts, you know, it's a technology that's designed to really get around the law. I cannot see that, you know, securities regulators around the world will just kind of acquiesce and allow a technology to, you know, kind of do their job really, and allow all of these cross-border flows of capital. I think we need to lean into it, and there needs to be more global collaboration. And so what, you know, we've seen the green shoots of retail investors investing in early stage businesses. What will this look like if we can allow it cross-border, and actually leaning into the regulation and figuring out how do we, you know, protect investors, still address all of the things that, you know, securities regulators are concerned about, but achieve this great outcome of people investing across borders, because, you know, it makes sense, but it's but for the law. So.
Yeah, no, exactly. And there's a place where technology and regulation really can work together, right? You know, regulation in financial markets is, you know, in most markets is there for a good reason, which is to protect people, right? Like, you know, you want to sort of, you know, protect against malincentives created by the market. You know, and not just, remember, for the sake of protecting people per se, but because a market that has malincentives can also just sort of collapse as a market, right? If, like, you know, if half of the, you know, sort of if half of the companies that were raising money in the financial markets were fraudulent, you wouldn't see anybody providing capital. And so the companies that were real wouldn't be able to raise any money, right? It's not just that, like, you want to protect people from investing in fraudulent companies, but it's that sort of fraudulent companies can sort of, like, you know, sort of poison the whole system for everyone. And so, you know, one thing you see with marketplaces is that, again, especially sort of today, like they work really, really hard to make sure that they're, like, creating the right internal trust environment. And that often means working alongside regulators, exactly like you do, right? Like, you know, it's not, you know, and so I'm totally with you, right? This idea of sort of, like, you know, sidestepping the legal framework isn't the right strategy. What we need is sort of the legal frameworks and the technology to, like, work hand in hand.
Yeah, absolutely. And I mean, this trust, it's with,
So
I mean,
important.
I suppose the nice thing about what we do and how we go about things, and the communities that we've built for companies, is that because they're raising capital, usually from their most passionate customers and fans, there's a natural tension that exists. There's a lot of trust and accountability. For companies to do well with crowdfunding, they need to lean into that, be super transparent, and, you know, and be accountable. And that's actually a really nice natural tension that exists that you know, keeps companies honest. And if investors are investing for, you know, for a return, I mean, of course, like, this is what we say to companies, it's framed as an investment opportunity, so it needs to stack up as an investment. But what helps you rise above is the purpose that you're addressing. So you've got, you know, a different group of people that are allocating capital. They're not just allocating capital for a return, they're also allocating capital for a purpose. And by building this relationship between the companies and the investors, they're more likely to do the right thing. You know, if they're not going to do the right thing by their customers and their most passionate fans, they've got far bigger problems than, you know, raising capital. So.
Love it. I think that's a great note to sort of, like, break on and ask if there are questions from the audience, because that's, like, you know, sort of the take-home message for the day. Questions for the audience. We can either get them in chat, or if you want to speak up, you can just, like, you know, hit the raise hand button and we'll call on you.
So Scott, there is a question, I suppose, I'm not sure if you or Matt could comment. And Matt, it's around the relationships or VCs are having with potential founders. And as you said earlier, Matt, you know, it's really critical that capital raising requires a lot of face-to-face meetings. Are you seeing, VCs or some of the investment communities? I mean, how are they trying to find new opportunities?
Hmm.
And what are they doing in this sort of, I suppose, pandemic period when they can't have those face-to-face meetings to build that initial trust?
Great question. I mean, so first of all, disclosure, I am not a VC, so I don't actually know precisely what nor have I ever attempted to raise capital from one, so I don't know precisely what the industry is doing. But my friends who are VCs, sort of, they've sort of said three things. One of them is, of course, the first thing they did, as the world was really realizing the extent of this pandemic and financial markets around the world were going haywire, what they really were focused on in that moment was their existing founders and trying to help them understand, sort of how to cope and like what they had to do. And they wanted to be like as available and as accessible to those founders as they possibly could, because they knew that every company was potentially about to go through a rocky period, whether for good or for bad. Right. Instacart was going through a great moment, but it was a chaos moment because they had to scale up by an order of magnitude, sort of in a way that they were totally unprepared to do. So the first thing that happened was everybody, sort of retrenched on their existing sort of portfolio companies and tried to help them stabilize. The next thing was, the sort of fact two is, their capital is, fact two is that, capital was was more volatile and more scarce, and so they were sort of being more careful. And as you said, exactly, the normal one-on-one meetings aren't happening, and so they were doing a lot of it over Zoom, right? Like one of my VC friends literally said, I used to have this many meetings per day, and my schedule was like back to back one-on-one coffee meetings, and now it's all of the time I spent in the coffee meetings plus all the time I spent walking to and from different coffee meetings are now straight Zoom calls. So he's now doing 1.5 times as many meetings, because he doesn't have the transition time. So they pivoted the structure of the model. But then the other thing, which is the upside, is exactly as we've sort of been talking about. They saw opportunities in new types of companies, right? You're sort of a lot of them launched sort of COVID relief sort of venture finance funds, right? And so there's an opportunity to invest in building new technologies that would help people in this moment. And also they did it more globally, right? If you're doing, as we've said, right, if you're doing Zoom meetings, just like you guys are here zooming in from everywhere, you can have people in Australia, sort of working with and or investing in people in the United States and vice versa. So again, I'm not in this business, so I don't really know what they're doing, but that's the way the outlook has looked from arm's length. Matt, does that jive with your priors?
Yeah, look, I mean, similarly, I'm not a VC, and it's I can only really speak to the experience of the companies that have been on our platform. But we're an all online process, so every offer typically has a handful of what we call wholesale investors. I think you call them accredited investors in the States, and we have to determine their wholesale or accredited status. But if they want to invest more than $10,000, so retail investors are limited to $10,000 per company per year. And as you'd imagine, these large check sizes, they're not people sitting home in their pajamas just kind of investing $200,000-$300,000 on their phone. They may have, but
nice job if you can get it, right?
Yeah. So, it does usually require several meetings. The largest single investment we facilitated on the platform was $1 million. It was someone that expressed interest at $10,000, mind you. But that took, 5 or 6 meetings for that investment to, come through. So it's still, it's an online process, but we facilitate the connections online, but then, the convincing and the investment, there's still old school capital raising involved. So it's meeting people. And to your point, Scott, all of this is done, online now. I think where we've got an advantage is, making these connections, starting these conversations in an online environment suits us as a platform. But yeah. I think about that, if you're wanting to, I mean, what do you do if you're a startup founder and you haven't got equity crowdfunding? You do the old thing, you go to these startup events, the pitch nights and meet with people, and these things just aren't happening. They're happening online now. So, and it looks like it's going to be that way for a while. So.
All right, well, we've come to the 10 o'clock, or just past 10 o'clock. So that was the hour, and there are a couple more questions on the chat. So,
I'm happy to hang out and keep chatting. Obviously, like some people I know are going to be like starting their workday, so I don't want to hold anybody up. But anyone wants to hang out and keep chatting for a little bit, we can do it.
All right. Well, why don't we keep going for another 10 minutes? And
Perfect.
have a hard stop at 10 past 10.
Love it.
Or Melbourne time anyway. Probably a bit
okay.
later,
Well,
Scott. So there's a couple of questions. I'm not sure. So there's one, Scott, for you, which is about the factors that drive a winner take all or a winner takes most end game in a marketplace business. Perhaps you could just talk about the framework. Or
totally. I can cover this one very quickly. So we'll have time for at least two more. So so first of all, my like mental framework for winner take all marketplaces comes from this like series of articles my colleague Tom Eisenman wrote, thinking about sort of platforms, I don't know, a decade ago. And the cool thing is, like, all of the framework facts are still true. Marketplaces and platforms more broadly are winner take all, or tend to be winner take all if there's sort of like, a natural monopoly or a protected monopoly, like a sort of like a regulatory sort of status that keeps you as the only player. Or if there's increasing returns to scale. So think like Amazon with logistics, like we were talking about, or very, very strong network effects, so that like if you're a platform that manages to capture a large enough share of the market, everybody wants to be on your platform rather than some secondary one. Think like Facebook. Or if there are very high multi-homing costs. This is the cost of using multiple platforms to do the type of transaction. So dating platforms don't have this, right? Like it's pretty easy to be on 5 different dating platforms. And shopping platforms don't have it either, right? Like you could buy from Amazon or like, sort of like any of 5 competitors, but the fact that Amazon has such incredible scale and such a strong sort of like, sort of ability to be the default, maybe like creates a little bit of multi-homing cost that pulls you there to start. Actually, super low multi-homing cost, think rideshare, Uber versus Lyft, right? Like these are essentially the same business. It's really easy as both a rider or a driver to be on both. But when do you see non-winner take all markets? It's when those multi-homing costs are super low. So like you can have 5 identical platforms that everyone uses all of them. Or when there's differentiated functionality, when there's like a real demand for different ways of doing things. So, why is there equity-based crowdfunding and rewards-based crowdfunding? Well, that's a totally different type of investor model and a totally different type of company model. And then why could there also be like sort of, debt-based crowdfunding? Same thing, right? So if there's differentiated platform functionality, that's when there's opportunities for lots of different platforms to grow. All right. We've got a question from Matt. If a marketplace's core business model shouldn't be owning customer connections, oh, I love this, in the form of subscription fees and such, what do you think is a more sustainable structure, especially in the PPE context?
Yeah, look, I mean, we do own, we share the connection with the investors. So when someone invests or expresses interest in a company, they, that's the company's connection, but it's also, Birchall's connection. I think in terms of us growing sustainably, and this is probably adding to your comments on like winner take most, winner take all markets. I think the reason why we've been able to do lots of campaigns and pull out ahead is, we've been really focused on keeping our, the companies happy, like, happiness. We're providing a better service than what companies had before. And I see those as the really kind of key pillars of our additional growth is how can we, better serve the companies to achieve what they want to do and therefore make the companies happier and make the investors happier. And what will make the investors happy? Better engagement with the companies, them achieving their financial targets, becoming bigger businesses, and ultimately, exiting and providing a return to shareholders. So that's, I think, where we feel we need to focus and make the impact, and, you know, serve the people that are using the marketplace for, you know, what it is that they want. And, you know, it's engagement with the companies and, you know, a financial return. And I think that really needs to underpin, you know, anything else that we look to do with the platform is always, you know, not how much additional revenue can it provide the business, you know, how much additional value can it provide the people that we're serving, because you'll figure out a way to, you know, if you're providing enough value, you can figure out a way to monetize it. So.
Totally. And footnote, the more value you provide, the larger your share of the eventual pie is, right? It's a simultaneous like value creation and value capture point. I say in my class that the take rate, like the amount a marketplace can charge per transaction, is a function of the perceived value it's created in that transaction. This is why the listing platforms that just do, you know, the care.coms that just post a listing make almost nothing per transaction. Whereas instead, if you have like a long-term relationship with your supplier or with your customer or both, you know, you actually like stand to gain much more, as do they. So it's a you know, really nice feedback loop. Cool. So we probably have time for one more question if we've got it, or if not, we'll just wrap. Thank you.
Yes, I think maybe we'll bring it to a close. So I'd just like to thank you, Scott, and Matt, for your great contributions today.
Thank you.
It's really fantastic to have people of your quality and experience and knowledge really sharing that in a forum which, you know, it's quite another factor of the pandemic world, where we've had people for a Harvard Club of Victoria event from all over the world. We also had a number of people who were registering from Europe as well, but we've recorded the session, so we'll send that to them.
We'll send them the video.
Yeah, the time zone doesn't quite work for them. But on behalf of the Harvard Club of Victoria, the Harvard Alumni Entrepreneurs Club of Australia, and also all the participants, all the people who came in and saw today's talk. We were very happy to have you, and it was really interesting, and I think everyone would have got a lot out of it.
Oh,
So
thank you so much. Thank you so much for having us, and all of you in the audience, thank you so much for coming. Like, you know, I love talking with anybody who likes to start their day thinking about marketplaces.
Anyway, thanks very much, and all the best, and stay safe, everybody.
Thank you.
Thank you.
Bye.